recording. So I'll start now. So look, my name is Rich Harvey, CEO and founder of Property Buyer. And today I've got with me Louise Sanghera from Zippy Financial Group. So thank you for joining us today, Louisa.
You're welcome. Thank you.
Great to have you on board. And today we're going to be talking about smart property strategies and how to get your finance pre-approved in these COVID times. Now, I'm sure you've all got a lot of questions, and I'd also encourage you, while we're doing our presentation, on the chat function on the bottom of your screen, if you do have any questions, please just bump them in there, and we will try to get to as many questions as we can at the end of end of today's webinar. We may try to answer some on the way for you if we have if we have time. But to kick things off, I'm going to give a quick overview of the property market as we see it today. I've got some updated slides and figures to share with everyone. I also will be able to give you a copy of our presentation. So if you would like that, just shoot an email through to info@propertybuyer.com.au and we can give you both Louisa's and my presentation at the end of today as well. So I'm going to start sharing my screen so you can all see what we're looking at here. I'll just start that in presentation mode. Here we go. So we'll kick off. So thanks again for joining us. So just as a way of background for myself, I've been in business for an amazing 20 years in October this year. And my company and myself, we've won over 34 awards for excellence, purchased over 3,000 properties. In the past, I've been the president of the Buyers Agent Association of Australia and also served for 11 years as the chairman of the Buyers Agent chapter, bringing some new standards and professional services to the buyer's agent industry. Also a qualified property investment advisor and a member of the Property Investment Professionals Association as well. So today, what's really happening in the property market? Do you believe everything you're seeing out there on the news, or do you consider it fake property news? Where's the market going to be heading over the next 12 months? And is now a good time to consider upgrading? And I'm going to talk about sort of the psychology of the current market and how to take advantage of the buying and selling conditions as we go through. So that's a quick snapshot of what we're going to get into. So let's rip into it. So this is where auction clearance rates have been trending for the past year and a half. You can see through 2019, before the federal election and the state election last year, auction rates were subdued. They're kind of around the percentages they were now, around the low 60s. And then when the very close election was called and got through it in May last year, we started to see a ramp up in confidence. And that translated into quite a warm and active market right through to February and March of this year. And then obviously COVID hit mid-March, consumer confidence fell off a cliff and then recovered actually quite surprisingly quickly in the property market during May. And obviously the second wave of infections in Victoria has definitely dented confidence again. And you can see that we're moving now forward to around that sort of mid 60% clearance rate. So it's a pretty decent clearance rate. Last weekend, we actually had a clearance rate of 64% here in Sydney. And if you look at all the various areas around Sydney, the city and east, almost 70%, inner west, 57%, lower North Shore, 76%, northern beaches, 63%. It's still pretty decent. So for me, that's still a healthy market. It's not a buyer's market. It's not a seller's market. It's just a sort of a really, fairly active market. But again, there's not enough stock. And that's the complaint we'll constantly hear. What's happened to prices in the past quarter? Well, basically, it's not as dire as the media has made out. In the last quarter, prices declined 2.1% in Sydney, 3.2% in Melbourne. We actually saw a slight rise in Canberra, Hobart and Adelaide, which is surprising, but still down in Darwin, Perth and Brisbane as well, but only small, relatively small numbers. Now, look, these are the headline rates. The actual reality is that prices, in my view, have probably dropped somewhere between about 4% to maybe 7% in certain areas. I think we're probably going to see a fall of around 10%, maybe a little bit more in certain pockets, but not the dramatic decline that we were expecting to see across the board. If we look at annual change in property prices, so if we compare this time, July last year now to July this year, Sydney and Melbourne are actually still in positive territory. Even though we've got a declining market, if we look at all the gains we've had on a year-on-year basis, Sydney's still up 12.1% and Melbourne is at 8.7%. So it's still very positive territory. Same for Brisbane and Adelaide, also in positive territory. So yeah, it's just sort of a sobering thought to see that we are still doing okay in the property market. Rents have been a really interesting category. Obviously, rents took a real hit when COVID hit. We're starting to see vacancy rates actually in regional areas are improving. It's certainly challenging with investment properties at the moment to get the rentals that you're expecting to see. Rents declined 1.3% in Sydney, 0.7% in Melbourne. But a lot of the other capital have actually seen some rises in rents as well. Now, if you look at where we are compared to the peak back in 2017, Sydney dwelling prices are actually 4.4% below where they were in July 2017. So we were heading back toward the peak, and had COVID not hit, we would have surpassed that, I reckon, by now. But because migration is down and all those other factors have affected the market, I think that we're going to go a little bit lower than that 4.4% based on all the factors going forward. So where is the problems? Well, this is to answer your question of all your clients, Louisa. Why can't you find anything? Well, this chart will tell you why. If you look at this orange line here on the chart, this shows the volume of new listings, not total listings, but the volume of new listings coming to market. And you can see here, just as a general trend over the previous years, we have two humps, the two camel humps here. We have a peak in listings around March, and then a peak in listings around late October, early November, as the spring season really kicks through. And then the winter period, it drops off a bit. But look at the orange line, which is 2020, well below the average of previous years. So we should be, certainly above around 50,000 new listings coming online, but we're only at around 31,000 at the moment. So the lack of stock, and that's obviously driven by vendors being scared, vendors being nervous about the market, and lack of consumer confidence going through. Now, the volume of listings in specific areas is obviously going to be very, very different depending on where it is. So let's have a look as we go through. All right, so what's happening with consumer confidence? Okay, so consumer confidence, I've mentioned it a few times already. We're seeing that it's taken a real hit in that April period, that April March period. But then it recovered. But then it's also now taken a bit of a hit again with that second breakout. But what's interesting is how quickly consumer confidence moves. So the media does definitely have a strong impact on consumer confidence and hence on property demand. So I would say, consumer confidence currently is quite weak, but it's on a recovery path, and we need to see more good news before we start to see those property volumes recover. As I mentioned, if you want a copy of the slide deck, just shoot me an email to info@propertybuyer.com.au, and I'd be more than happy to share all these slides to save you taking lots of notes on the way through. So, question, has coronavirus fundamentally changed the property market? I think in some ways it has, and it will continue to do so, but there are some things that won't change. So what do I mean by that? Well, key drivers of the property market have always been these things: population growth, migration, employment, the economy, interest rates, and building approvals. So we'll just talk about them briefly one at a time. Now, population growth will definitely slow this year. We're seeing migration numbers drop off by anywhere from 60 to 70% in the next 12 months as the borders are closed. But that's a temporary factor. We've also got natural growth, but it's not strong enough to sustain a good property market. We do need a skilled migration program in Australia to really kick us along. Employment's obviously taken a big hit. We were at around 5.5% unemployment rate. That will blow out, they reckon, at the peak of the coronavirus at around 10%. So it's a bit higher than everyone would like it to be, and it will take a little time to recover. So that's going to have a detrimental effect on the property market as well. Obviously, the economy is in a recession at the moment and likely to be in a recession till probably early next year. But interest rates on the upside are their lowest ever. If you're looking to get a low interest rate, I won't steal your thunder, Louisa, but that's your domain. And building approvals are obviously down as well. But again, these are temporary setbacks. So what are the buyers wanting to do? Well, I was trying to think of an analogy, and this is the best one I came up with. It was a seagull under a hot chip. There are buyers out there and they're intensely watching the market. And we're starting to see now more buyers come out of the woodwork and pounce on opportunities. So I'll tell you why I think this is a good time to pounce. So this is what most buyers will go through. They'll go through this cycle of emotions thinking, yep, I think I'm confident to buy. I really think it's a great time to buy. I'm really jubilant. Then they make the decision to buy and then they get worried, nervous. and then they hear the news and they get really depressed. But then they come off the other side of that with perhaps a bit of reassurance, relief, and then eventually confidence. So it's good to be aware of the kind of emotions that you go through when you're looking to buy a property, because that will have an impact on your decision making. So what are some smart strategies that I would recommend in this COVID environment? Well, number one, buy at a discount to long-term market value. This is a time when you can actually buy a good quality property at a discount. It's very rare that you have these sort of periods of time in a property cycle where there's a lot of negative factors around, quite a few, not just one or two, but a couple of factors. So my reasoning for buying now is, rather than waiting another 6 or even 12 months, is that once we start to see good news, like a vaccine produced and being widely distributed and the numbers of cases and deaths going down, there are going to be a lot more buyers will be entering the market and trying to compete for the scarce number of listings that are on the market. I believe it's actually better and you can get even deeper discounts that will make up for potentially even further falls by buying now, and others are watching from the sidelines. Another great strategy is to buy and add value. So simply doing a renovation and creating your own capital growth, not trying to wait for it to come along by market forces. Adding a granny flat for getting a secondary income. And if you're looking to potentially sell a property, I've found that we've had some clients sell off market for quite a good price. It won't be sort of breaking any records, but it means that you can then move on to your next chapter in life. And we have actually buyers waiting in our books looking to buy properties as well. So, golden question, where are properties heading at the moment? Well, wouldn't you like to know? I'll just rub my crystal ball here for a minute and let's have a look at where we think they're going. But before I do that, let's have a look at in the historical sense of where property prices have been for a while. If you look at all of the sort of major factors that have occurred over the last, say, 40 to 50 years, there's been a number of shocks. We've had oil price shocks, we've had some Vietnam War, we've had negative gearing quarantined, we've had lots of stimulus packages. But I guess the takeaway message on this chart here is to look at all of the times when the property market has been in negative growth territory versus positive growth territory. So you see these circles, this will show you the 6 times when we've had, or sorry, 7 times I should say, including now, where we've had a negative price in the negative price growth in the property market. But it's always been followed by strong periods of time where it's rapidly rebounded. So that's just something to bear in mind, that there's pretty good fundamentals in the property market going forward. And if you ask this question, where are property prices heading? Well, market sentiment is volatile, as I said before. We're starting to slowly see an increase in turnover. All of the agents that I'm speaking to, a question I ask them is, when are you expecting to see listings increase? And they're all, again, talking about spring. So I definitely think spring, October, September, we'll see a lot more properties coming on the market. There's 2 key things to look for. It's the number of sales and the number of listings. As long as the number of sales outpaces the number of listings coming on the market, that's called the absorption rate, then everything's rosy. But if we start to see a lot of sales hanging around and there's a big buildup of stock on market, that will see prices drop further. It's a classic supply and demand scenario. So I think the relationship between new listing sales is a critical thing to look for to show you where property prices are heading. And that's one thing that I'll be writing about and watching very, very carefully in the months ahead. So how should you, as an ordinary buyer, think about approaching the market? Should you sit on your hands and keep your powder dry, or should you perhaps consider dipping your toe in the water? Well, my view, and I've always done this, I've always been a counter-cyclical investor and buyer and done extremely well. During the GFC, I bought 3 properties in that year and have been buying consistently since. And I'm at the moment refinancing now to look at buying my next property as well. If you look at what the media is talking about with JobKeeper, there's been a lot of predictions about the September cliff. You know, property prices are going to fall off a cliff. Well, JobKeeper has actually been extended, as we know, so I don't think that stimulus drop-off will be as dramatic as we saw. However, unemployment is a big factor and is having a dampening effect on the economy. So we're going to see, as I said, unemployment reach around 10%. But I would approach the market with what I call cautious optimism. You will need to have a really diligent approach to your research to identify properties that represent good value and aren't just being sold for a discount because they're no good. And again, you're going to need to get the right team around you. Get a great finance broker like Louisa, get a buyer's agent, get a solicitor, pest and building inspector and tax advisor to really be part of your team. So my view is always to buy straw hats in winter. You know, this is one of those rare times in the market where you can buy at a discount. Again, there's no major rush, but my thinking is there will be more competition as we start to see positive green shoots in the media and positive green shoots around the world for recovery. So that's my general advice. What are the 7 steps you need to do to buy well? Well, just very briefly, if you are considering buying a property, first thing you need to, before you go shopping, is to work out your numbers and your finances. So, and Louisa will cover that process in a minute about getting your finance pre-approval. Then once you know that, then it's a question of your strategy. A lot of people just jump onto realestate.com or Domain and start searching for properties without thinking about, hey, what's my strategy? So if you're upgrading your home, you've got to think about not just the next 2 years, but the next 5 to 15 years where you'd like to raise your family and have access to transport, school, shops, all of the amenities like that. If you're an investor, you've got to think about, what do I want this property to do for me? Is it going to be more of a growth property, something I renovate, or is it something that's purely just going to be a cash flow or a yield play where it's going to supplement my income or potentially replace my income one day as I build a portfolio? So what we do with our clients is spend a bit of time having a strategy discussion, and then from there, that will determine the type of property and the area that we buy in. Then you've got to research the market. So you've got to research the suburbs. There's 15,000 suburbs in Australia, 750 suburbs within Sydney itself, and you've got to identify which ones will have the best potential for growth and yield. Then you get out there on your bike, have a look at some, shortlist them, evaluate them, do your due diligence, negotiate them and settle them. So they're the 7 steps you need to take to buy well. A couple of quick case studies on what we've done recently for clients. I buy a lot of off-market properties for my clients. We have over 4,000 agents on our database, so we can very quickly access properties you won't otherwise find. But I bought this lovely property here in Manly. It was 400 metres to the wharf. Client and investor had a budget up to 1.2. They're quite nervous investors, hadn't really invested much in property before. And we were looking up around the Mona Vale and that sort of area, Warriewood Way. Found some older units that needed work. Anyway, we found this one. It was virtually renovated. Great spot, 400 metre walk to the wharf. Appraisal came in at 1.3 and managed to get it for 119. So it was great. The young couple that were selling were moving on, getting married. So we're there at the right time in the right place. And that will rent for about $800 a week. So great long-term buy in a fantastic location. I recently just bought another property in the Forest area for a client. It was a home buyer looking to upgrade. Now this particular property had an offer pre-auction at 1.6, and the owner's expectations were sort of the low 1.6s, and that was all the agent's indications. But has it been, some of the buyers got a bit nervous and pulled out. One pulled out due to finance, couldn't get it quite together in time. And I just kept monitoring the property. I thought it was going to be too good for my clients. We're out of their reach. But as it turned out to be one we got for 1.5 and saved them 100 grand. And literally another property down the road sold the same weekend for 1.43 that was completely unrenovated on a worse block of land. So it just goes to show, if you're there at the right time, you can actually pick up really, really good deals at a significant discount to long-term market value. This is a quick testimonial, but the clients for these guys, they just weren't aware that you could actually find off-market properties before. And they were just absolutely over the moon. They've got a couple of dogs, 2 young kids, and they were just really, really thrilled with the outcome. So really happy for them. Another one we did was in Western Sydney. We've done a lot of this work for other clients before, those that are chasing both yield and growth. So we found actually a house. We got this one for $670,000, already had a granny flat in place. So had really strong cash flow, and we managed to save our client 65 grand. Again, it was just finding the motivated vendor, finding the opportunity, and also our long-term relationship with that agent that enabled us to get this property. And lastly, another one on the northern suburbs up toward the Hills District. Now this property came on the market. This is an on-market property. Came on the market on a Wednesday. I inspected it with the clients on the Thursday morning, did my appraisal, started negotiating it, and we had it exchanged on the Friday. Now, the agent was really reluctant to take me through. She said, "Oh, Rich, why? I don't really want to take you through." Anyway, she took me through and she goes, "I don't know why I've done it, but I just explained my clients are all finance approved, ready to go. We're making genuine offers." But we got a fantastic result for them. It did need a reno internally. The kitchen was a little bit pokey and needed an upgrade, but had all the right bones for a fantastic family home, 1K from the station and opposite a park. So clients were just, again, over the moon with that one. So that's pretty much, gone too far. That's pretty much all I've got for this stage. So as I said, if you'd like to get in touch with us, if you are thinking about buying a property, I would advise you get your pre-approval in place, have a think about what your strategy needs to be. And if you need help with creating a strategy, please give us a call, get in touch and have a chat to myself and my team. We'd certainly love to help you find the ideal property and be on your side in that journey. I'm going to stop sharing my screen and come back to you, Louisa. Are you there? Perfect. So, Louisa, can I hand over to you now? I'll pull up your slides and run with them, but can you please give us a little rundown on who you are, how long you've been in business, and a bit of background would be great.
Yeah, absolutely. So I was in a bank, a major bank called NAB here in Australia. And they actually owned 4 banks over in the UK. So I did nearly 30 years in banking and ended up sitting at board level for the bank over there. Loved being an operations manager, loved my job, but had a little one. And when he was 9 months old, we actually emigrated across to Australia. So still got my dodgy Yorkshire accent, but it's going nowhere fast.
We love your accent, it's great.
I know people say that all the time here, which makes me really happy because in the UK, from the north, everybody takes the mickey out of your accent, but here it goes down really well. So I love that.
Good on you.
So yeah, so big banking background, and then had 2 kids and basically didn't know whether to go back into banking, but I really didn't fancy traveling to the city, going back into that corporate background. And I just thought, mortgages are really easy for me. I've been in this space for, over 25 years when I came into mortgage broking itself. So, yeah, it seemed like a good career, and I thought I'd do a few mortgages to help pay for their bills, but within a very short space of time, thanks to lots of local mums at schools, my business really took off quite quickly, which has led to lots of success over the last few years.
Very good. Wonderful. Well, I've got your profile up on screen, so I'll just keep flicking through the slides and tell me if I'm too slow or too fast, please, because I'm controlling the slides. So
okay, yeah, you can skip. So so this is we're not mortgage brokers at Zippy, we're finance brokers. So mortgage brokers just do mortgages, because that's their experience. We're finance brokers. The difference being that we do commercial lending, asset finance, debtor finance, trade finance, all your car and vehicle finance as well. And that's purely because that's my background. So when I was in the bank, I've been a business manager, I've been an asset finance manager, I've worked in the commercial space. So I was in credit. So I actually worked in credit for the banks as a credit manager. I worked in compliance, or you name it, I did it. So I've got a strong financial background, which I brought into the team. And what I've done, I don't actually bring people in to train in my business. I go out and I look for people that have got lots of experience, just as much as myself, or if not more than myself, and I bring them in so that they're basically up and running. So we don't have any new starts that we're training or anything like that. But so we do all things financial, but our bread and butter is the mortgages for owner-occupieds and investors. It's probably 95% of our business. And we like to think that, we're really good in that space.
That's great. Okay.
The people we work with are people like yourself, buyers agents, real estate agents send their clients through to us. We have a lot of accountants that send us their tricky deals. So they never really send us anything vanilla. If there's something that's really difficult, the accountants are always shooting it across to us to sort out. And same with financial planners.
Okay.
So, but our main referrals are actually our clients. So our clients refer us 95% again of our business, which is great.
And you won a couple of awards along the way. Well done.
Yeah, there's a few more added on there. That's last year's. We have won some. We just won customer service for the second year running in the industry.
Well done.
Last week. So we were voted best mortgage brokerage in Australia in the investor space, because we are quite big in the investor space. I'm an investor myself. I've got properties in 4 states. I've been in property since 1986. So yeah, we're big in that space. But yeah, we've been doing rather well in the industry,
That's
which
wonderful.
is really for us.
Well done.
Yeah.
All right.
So I wanted to get straight into the COVID issue, because that's what everybody's asking me about, Rich. You know, it's what's happening. Is it difficult? The answer is yes. You know, there's no sort of way around it. It is a lot more difficult right now. Obviously, the banks aren't wanting to get people into trouble financially. They're being very conservative. They're being cautious, and rightly so. But when COVID hit, you know, I think we had a lot of panic for a couple of weeks, and our phones were ringing, and our clients, even though, you know, nothing had happened to them, there was a lot of what if. So there's a lot, you know, we spent a lot of hours just reassuring people. But luckily the banks have really come out and supported people quite well, and are continuing to do so. You know, we're hearing that they're going to continue that into 2021 to support people. They don't want people losing their houses. I think the banks are going to do everything they can to assist. And so people should take comfort, you know, from that. The whole issue about deferring payments, the banks did come out straight away and said, you know, don't worry, we'll defer your payments for 6 months. And people jumped at that to defer the payments. We actually got an EDM straight out to our clients to say, don't jump straight into a 6-month deferred payment. We really need to look to see if you do need that, because when you are deferring your payments, if you basically stop paying, the interest is still running and you're not repaying that mortgage. So if you defer it for 6 months, at the end of the 6 months, your mortgage is going to be bigger than it was to start with. So it's going to cost you. So we actually...
Louisa, can I just ask you a question? Would your advice be, if you're in a good position financially, there's no reason to defer, and you'd recommend paying it off? But if you're struggling, take advantage of it.
Yeah, if you're in trouble, if you're really worried, if you've lost your job, you don't want to be using all your savings up, then go and speak to the bank. But a lot of people have jumped, and the banks have said this. There's a lot of stats there now to show there are a lot of people did jump into this that really didn't need to, and they're paying a price for doing that. So we had one client out of our whole portfolio that did decide to take the 6-month gap. But what he did, he actually paid, we spoke to us, and he actually paid interest only payments. So he was paying something off.
Okay.
And he didn't need to do that, but he'd lost his job. He did get a big payout, but it just gave him comfort, so that was fine. He's back paying his mortgage in full now. We had a couple of others went to interest only for a few months, but again, all our clients are actually back paying the normal mortgage instalments.
Okay.
What we encourage people to do when they originally take the mortgage out, because I'm a big fan of paying your mortgage off as early as possible. I am. It's like, yeah, let's take the 30-year mortgage, but if you've got extra money, let's bang it away. Let's get that debt down as fast as we can, so that we can get your retirement planning done and get you retired nice and early. Or let's repay that debt down on that owner-occupied, which is going to free up equity that we can then draw out to go and get some investment properties to help grow your wealth. So I do encourage our clients, when they take the mortgage out, always to try and put extra in. And what we said to the clients was, you know, all right, if you think you're worried, stop paying the extra. If you have been paying extra, you can reduce your payments down. Let's just do that for a little bit. And that's generally what we've done. But I feel quite lucky that we've not got anybody in trouble. Not even any of our commercial are in trouble.
All right.
So that's great.
Well done. Shall we go to the next slide?
Yeah.
Okay. Super.
One of the issues we're currently having with applications is people are coming to us that have taken out their $10,000 out of the superannuation. So the government, I think, didn't make this clear enough to people, perhaps, that people were allowed to access the super if they were under financial hardship. But what people did, they saw that as a green light to go and take the $10,000 out. I was watching a program the other night about people, you know, gambling that away, buying cars, doing all sorts of things with it. And people are trying to use it as a deposit for the property. The banks will not take that money as genuine savings. Most banks want 5% genuine savings when you're buying a property. They're not going to take that super money. In fact, a lot of banks are not keen to lend to you because you've basically highlighted that you're in financial hardship, and that's why you've taken the money out. We've only got a couple of lenders, and it is a couple, that will give you a mortgage right now if you've taken that $10,000. It can be used for funds to settle the mortgage, but it still can't be used as genuine savings. So we're saying to everybody, don't access your super unless you really need to. Yeah. If you're a self-employed applicant, if you've put yourself, your business, if your business has gone on JobKeeper, the banks won't lend to you right now. So if anybody's wanting to buy later on in the year and you're self-employed, you need to consider that, but you won't be able to have your business on JobKeeper.
Okay.
Right now, you're going to have to produce a lot of documentation to the banks. So it's probably double what it was before COVID. So even, I've just done a mortgage, I'm just settling on an investment property in Perth. I've got my 2020s ready, but they still came back and asked for my individual quarterly tax returns for last year because they wanted to see if there'd been any dips each quarter, you know, and they're asking for documents again at unconditional stage on mortgages, which we never had to do before. And even before settlement, the banks are coming back again and they're asked to see up-to-date documents, pay slips. They're phoning employers up on date of settlement, checking that you are still employed that day. If there is any changes to your job, reduced days, reduced hours, anything like that, the bank may not well settle. So people have to know that when they're going to buy right now, they've got to be confident that they're not going to have any changes to their employment between purchasing and settling. Okay. Really important.
All right, we'll go to the next slide.
The other thing that go ahead. The other thing that they're going to look at is living expenses. And they're going to be looking at 3 to 6 months bank statements, and they're going to be ticking those off line by line by line to look at your living expenses. So living expenses have to be fully declared, and that includes all your discretionary spending. So that's the thing at the minute that really looking at. Okay, interest rates. Obviously people, the first question they ask when they come to us is what interest rates can we get? It's usually the last thing we look at as a broker, but they always ask the interest rates. So we have got good rates on, you know, we're in the low 2s now, which is fantastic. So I just put a few there on slides. You know, we're getting, we've actually got some 219s on fixed this week. So we're going for 219, 229s fixed, 259s on variable, a little bit more for your investors, of course. The investment loans are always a little bit higher. But as you can see there, there's some great rates. I just wanted to put the monthly installments on there because when people come to me, they'll say, oh, that's not a lot of difference, is it? Sort of 259 to 269. It actually is. When you look at the dollar amounts, I'll say, well, do you want to save $39 a month or not? Because that's the difference. You know, and that's only that 0.1. When you increase into 289, look, it jumps up to the 3118. So it's a significant amount, you know, significant difference. And people need to keep in mind that interest rates might go up. So they need to be looking to make sure that they can afford the increases to interest rates as well in the future.
That's a really good point, Louise. It's like you're saying, get ahead, because you time that, $119 by 12, by 3 or 4 years, that's significant. And if you can get ahead now before rates go up, it's a great thing to do. So I think I agree to look at that.
Yeah. Okay, when people come to us, they always ask about interest rates. As a broker, we don't just look at the interest rate. When you're looking at a bank, we do look at the interest rate, of course, but we're also looking at what upfront fees are they charging, what annual fees are they charging, what monthly fees are they charging, because it makes a difference. Somebody might offer you a real cheap rate, and I see this on social media all the time, where somebody's flashing a cheap rate around, but when you go and look at the deal, the fees are really high, so it's actually not that cheap. And we see a lot of banks offering the cheap rates, and we know that those banks do suck people in for a cheap deal, and we know within a short space of time the interest rates are going to be going up, and they put large discharge fees on the end, something like $1,500, which basically really stuffs you up. Once they've increased that rate, it stuffs you up in getting out, because you've got that large fee to get out. So as a broker, you learn over the years who does that and who doesn't do that. So we avoid those deals. Not all products have the same features. So again, you might see a cheap deal, but has it really got the features you want? Like if you're wanting to put in extra funds, does that product that's offering you the 2.09 allow you to put extra money into it? Because if it doesn't, it's not right for you. And people come to us. We have a lot of barefoot investors come to us. Barefoot investors love ING Bank. ING Bank are the hardest bank to get money out of right now. So we always look at the ING calculators first, because we think, right, if the client can service with ING, they can serve with any bank in Australia, because we know that the toughest bank to lend money, to get money from at the moment. But, but if you come to me with a bank, they might not be the right one for you because of policy, you don't fit. There's lots of reasons why that bank might not be right for you. So, and that's where people walk into their existing bank. They've banked with them for 30 years. They think the bank's just going to give them a mortgage straight away. They don't realise that bank doesn't take casual employment, so they won't take them as a client. So they're declined and out the door. So we do all that up front. We check the policies. We check that the clients can pass the bank's debt servicing calculators. We make sure they're going to be approved before we send it in.
Excellent.
So one of the things I'm getting a lot this year, since January, people come to me all the time and say, I must have an offset, I must have an offset. My dad's told me to get an offset. My mum's told me to get an offset. I've been telling people for the last 25 years to get an offset account with a mortgage, because it was a benefit. And it was a benefit because generally the package deals that have the offset used to be significantly cheaper. You used to pay a $3.95 fee, but we'd say it's worth paying the fee because look at the cheap interest rate you've got on that deal. It's worth taking the package. That has changed. The package deals now are basically priced the same as the basic mortgages. The difference is that with the package deals, you are paying a $3.95 annual fee. You're paying a $2.50 settlement fee. And they're significant. $3.95 a year over 25, 30 years is a lot of money. So when the two products, the basic mortgage and the package mortgage, are offering you the same rates, is it really worth it for you for that offset account, paying all those fees? Because the basic mortgage has a redraw facility. And a redraw facility works exactly the same as an offset account. So whether you stick your spare money in an offset, or whether you stick your spare money into the redraw facility in your mortgage, it's still saving you exactly the same amount of money. So you've got a question now with this change in the market. Is it worth having the offset accounts? That's something for people to consider.
Excellent advice, Louise. I love it. That's really great. Really good.
We do have a lot of clients obviously coming to us that don't have any savings, but desperate to buy a house. And so what we generally do with those clients is we send them a budget spreadsheet. We tell them to work on a budget. we'll run through that budget with them and agree what they can save. But there's lots of ways to save. A great one right now is that people are going to be getting the tax refunds. And what do people generally do with the tax refunds? Generally they go, oh, we'll have a holiday with that, or oh, I'll upgrade the car. Well, we can't go on holiday right now, so you don't need to spend it on holiday. But, you know, save that tax refund and pop that in your savings account.
Excellent idea. Great idea.
This slide is talking about the holidays. So again, we're not taking the holiday. Big savings this year. I'm not taking as holidays. Stick them in your savings account.
Excellent. Yep. Good idea. I think we can holiday at home and save some money, you know? So
yep.
Good idea. Yep. What about that car? Should we get new cars?
No, don't get the car.
Why not?
You know, it's actually our biggest issue we have, because generally people buy a house and a car within 6 months of each other. And so what we always say to people is, if we can, is buy the car after the house, because you'll always get a car loan after you've bought a house, because they don't debt service you like the banks do to get the car loan. But if you've got that car loan before, that is going to block your maximum borrowing. And it's a big impact when we show people the gutted. So we see cars blocking people getting the house all the time. So don't buy the car, save the money.
Good
so
advice.
Get the budget spreadsheet and stick to your budget. That's the thing, is stick to it. Make yourselves accountable, check in every month.
And what I'm hearing you say, Louisa, sometimes you need someone else who's independent outside the family budget to come in and help you make these tough calls. But when you show people on a spreadsheet that, look, you know, buy the car 6 months later, a bit of deferred gratification, you're actually going to get a much better result long term. So good on you.
Yeah. I have diary notes in on some clients. They ask me to make them accountable. So I have diary notes in just to pick up the phone to go, how are we going with that savings then?
So what are the no deposit options we've got here?
So we've got parental guarantee and family pledge. So basically the same thing. Parental guarantor has obviously got to be a parent. Family pledge can be a sibling. But this is where if you don't have a deposit, if they own a property, they can offer their property as security against your house. You will take 2 mortgages out. One would be an 80% loan to value mortgage. The second one would be a 20% loan to value mortgage plus stamp duty fees and charges. The parental guarantee is basically guaranteeing that second mortgage, the smaller one, just the 20% plus stamp duty. And it's changed a little bit, this. They don't just have to have a house now, they are assessed, and the banks are looking to check that the parents do have superannuations and savings, because if worst case scenario, they lost their house, the bank needs to make sure that they're not out on the street. So there's been a little change there. And that works the same as the family pledge.
Okay, fantastic. Well, it's good to know there's different options out there for, especially for younger generation that's taking the property market gets further out of their reach. So it's a really good strategy.
Yeah, we're doing more family pledges than ever. We've done more this year than ever, because we've got a lot of first-time buyers in the market.
Yeah, so what's happening with first-time buyers? How can they get funding?
So here we go, the first-time buyers. They've got lots of offers available. First home loan deposit schemes there. This is going really, really well. Only 27 lenders involved, but still plenty of lenders. And basically this is where if you've got 5% genuine savings, the government are covering the rest of the lender's mortgage insurance for you. So that's available. First homeowners grant, that's where you're going to build a house up to a maximum of 750. So a bit restricted around the Sydney area, I know, but plenty of opportunities, Central Coast, out west, and even down south. But yeah, so you've got the first homeowners grant of 10,000 if you build.
Excellent. Okay.
A couple more.
Let's go to the next slide. Stamp duty concessions, first home loan buyers.
Yeah, so the stamp duty's just changed, you should be aware. So you've got stamp duty concession up to 800, and if you go over the 800 mark but under $1 million, you still get some stamp duty concession. So again, that's helping out all these first-time buyers. And the latest thing to come on is the home build scheme, where they're going to give you $25,000 if you're building a new home or doing a substantial reno. The max build has to be 750. The reno has to be a max of 750, but the house can't be valued more than 1.5 before you've done the renos on that scheme. But 25 grand there for them. You know, if you put the home build together with the stamp duty concession and everything else, some nice savings to be had.
Okay, well, some good incentives there that people can certainly take care of. So again, I just advise people to be really careful about their property selection, make sure it's in the right area, not just take advantage of any concession just because it's there. So make sure you don't skimp on the research. What else have we got for first-time buyers?
So for the first-time buyers, some of the banks got special deals on for them. We've got some cheap rates that are on honeymoon rates where it's a discount for a few years. We've got lower interest rates on the higher LVRs. So the ones that don't have the deposits are normally paying high LVRs, but the banks have lowered those down for first-time buyers. And then we've got things like St. George Bank. They're doing LMI for $1 at the minute, which is fantastic.
Have you ever seen that before, Louisa? Is that a first ever you've seen in your career?
It is. Well, we have got, look, there's some industries that don't have to pay lender's mortgage insurance with some lenders, doctors, lawyers, accountants. But that's the first deal I've seen in some
pretty
time.
Good, isn't it? Yeah, pretty attractive, eh? Yeah. That's
awesome.
Okay. All right. And next slide. Investors. What do we do with our investors here? What do we got?
So I just want to give investors a little, some tips around the structure, because I see a lot of investors coming to us with the structure all done wrong, and it's blocking them from getting that next investment property. So you mentioned earlier working with a team. When you're an investor, you really do need to work with a team. You do need a good buyer's agent, good accountant giving you tax advice, good mortgage broker, and you've got to get the structure right. So, I have investors that have cash and they'll say, oh, I'm going to put some cash in. Do you really want to be putting cash into an investment property, or do you want to be borrowing 100% to get the tax advantages? And do you borrow that 20% deposit from the owner occupied on a separate split, and then borrow the 80% on interest only on another mortgage? So your accountants generally like you to keep all your splits separate for them, because it makes the tax really easy for them to work out on each property. So, I've got lots of splits, but I've got my main owner occupied on P&I, and then all my investor splits are all on interest only. And then when I always buy at 100%, I never throw cash in. So I always borrow 20% off my owner occupied, 80% off on the investment. I go and get the best deal on the 80% investment, and I just stick the 20% on my existing mortgage. And then obviously I'm going to keep refinancing my existing mortgage to keep that competitive all the time as well. Right. But I see people that come to me and they might want a construction, or they'll have gone to a bank and they'll have got approved, and then they come back to us and they go, I refinanced, and now they're telling me I can't do the renovation because they don't do construction. So if you're thinking of doing a renovation, you need to tell us that you're thinking of doing that in the next 12 months, so that we know not to go to a bank that doesn't do construction.
And that's a really good point, because sometimes I think the buyers think that, any bank will do this policy, but they don't. That's why, I reckon, how many loan products are there out there, Louisa? Probably 1,000 loan products.
We've got thousands.
But you have the ability to work out which product is going to suit a particular strategy. So that's why I recommend people start that conversation very early with a broker and make sure they get the right advice.
Yeah. Equity release is a really common one. So most banks will only let you take $100,000 equity out your house at any one time. So if it's somebody that's wanting 200,000 or 300,000 for whatever reason, we need to take them to the bank that's going to allow them to do that. So we need all the information up front, and then we can work with it.
So what are some other hints and tips you got for us today, Louisa?
So, just hints and tips. If you're going to be buying a house, and you're also thinking of changing jobs, perhaps go and have a word with your broker about doing that, because that might actually stop you from buying the house. If you're going to go on maternity leave, or if you're on maternity leave, you need to go and speak to your broker up front and tell them what's happening. You can get a mortgage when you're on maternity leave. But there's rules around that. So, but just come and talk to us early so we can see if you're going to qualify for it. You know, casual employment, a lot of banks don't like you under 12 months casual employment, but we have got banks that are under 6 and 3 months. So if you're casually employed, let us know. Credit cards, banks do not like you having credit cards with big balances on if you've just been putting all your household debt on there, because that to a bank indicates that actually you can't afford to live off your cash. So you can't afford to live off your wages. So you're having to put all your bills onto a credit card and pay 20% extra on the credit card as well for those bills. So we always say to people, you know, don't spend on your credit cards. If you're spending, repay them in full, pay your balance down to 0.
Yep.
Bonus and commissions. We get people that earn big bonus and big commission, and then they change a job and they think that we can use the bonus and the commission that they've earned previous years. Well, we can't. When you change job, you have to have 2 years in that job before we can use the bonus and commission. So again, if you're thinking of changing jobs when you're looking for a house, come and speak to us nice and early so we can explain the rules to you.
And you've got to be upfront about the defaults. That's critical, right? Because as you say, the bank will know if you've defaulted, right?
And banks will take you with defaults. Certain banks will. They're the banks we need to go to. You just need to tell us so that we can put you in the right bank.
Yep, great. All right, what else have we got on tips?
I'll skip through some of these, but I mentioned overtime, child maintenance. If you've just got a nice friendly agreement with your ex, the banks won't take that income. You do have to have a legal binding agreement, or it has to have gone through family courts. So if you're going to come for a mortgage, you might need to think about putting something in place. If you're not an Australian citizen, you need to be telling us what visa number you're on, because banks have lists of visa numbers that they will accept. So we have to check that they're going to take you. So always declare everything on your bank statements, because they are going to be looking through, and if they see that you've got an Amex card on there that you've not declared, they're going to spot it. If you spend, you know, $1,000 on takeaway a month, declare it, because they're going to see that you're always having your takeaway. So there's no way around that and covering it up.
Can't hide. There's nowhere to hide from these banks.
There's nowhere to hide on living expenses.
There you go. Yeah. The next one we've got.
Don't always think that the bank are going to accept the security. So banks don't like company titles, heritage listings. They don't like multiple units on single title, rural, service department, student accommodation. There's banks that will accept those, very few. And so you need to tell us if you can be buying anything like that. You know, they don't like units under 50 square meters. So if you're looking at something at 35, come and tell us. So don't assume that they're going to take any security. If you're self-employed, always keep your BAS up to date. It's really important, especially now with COVID, because they are looking at your BAS. And always keep your IDs up to date. So don't come to us with a driver's license, passport and birth certificate all in different names. You're going to have to sort it out, and then you're running around like a headless chicken trying to get it all done. So try and keep your ID up to date. And I said, just remember that just because one bank won't take you, it doesn't mean that another bank won't take you. There's always room for, you know, there's always usually a solution. Very rare there isn't. All banks have their own policies. They all have their own debt servicing calculators. You should fit in somewhere. If you don't, we'll tell you what you need to do so you can get it over the line. And there's things like banks have postcode and building restrictions. We just had one last week. They went to buy an apartment over the other side of in Sydney near the airport. And the bank came back and said they wouldn't lend to that apartment because they'd already let to too many apartments in that building. So things like that do affect what you're purchasing. So that's where we need to do the checks for you. Got to check on the banks all the time because the deals change daily. You know, banks have cashback offers. They have these special first-time buyers offers, reduced LMI as we've shown you. So don't think what you saw last week is necessarily the best deal this week. And it always pays to shop around. Rich asked me to list 6 things to do before you go for your mortgage, and this is the 6 things I came up with. See a broker nice and early. The earlier the better as far as we're concerned, so we can tell you how to plan and what you need to do. Set yourself a budget, watch your discretionary spending, keep that to a minimum. Pay off Zip Pay and all the interest-free type things. The banks don't like them. Reduce your credit card debt. If you can, close the credit cards that you don't need. Don't buy that car, as we mentioned earlier. And look at your budget yourself and make sure that you are comfortable with the debt that you're going to take on, because even though the banks might lend you that money, you've got to be comfortable paying that debt. And as I said earlier, you've got to be comfortable that you can afford to pay that when the interest rates go up to 3%, 4%, 5%.
And I think, Louisa, that's a really good point, because it's the sanity test. And I think having someone like you that's not just a mortgage broker, but almost a finance advisor, finance broker, you're going to tell them a lot more information to make sure it's a sustainable debt. They're not getting in over their head. So really excellent points there. Really good points. Yeah.
There you go. So that's my hints and tips.
Fantastic. Well, look, thank you, Louisa. If you'd like to get in touch with Louisa, highly recommend her service. Outstanding award winner, great accent, just a pleasure to talk with you on the phone, just to hear that accent. But no, Louisa, we really appreciate those tips, and I think they're really, really valuable. Some of them are just so practical, obviously the win a bit about the car, and also just being really transparent about everything that you're preparing on those loan applications. We've got some time for Q&A now, so I'll just stop sharing the screen and we'll go back to our faces. But there is a question. Someone asked, might have been my presentation, are these prices based on real estate advice or registered transfer of ownership? Could there be a lag on the sale prices? Yeah, look, good question from Greg. There is a bit of a lag. Typically it's around 6 weeks, but CoreLogic are tracking option prices. So they're getting a mix of both live data and data that's also about 6 weeks late. So it's a combination of that data, but I generally believe there is a bit of a lag. That you've got to be at the coalface to understand the most recent sales that are happening week by week, just get a sense of where the market is at. I think there is a chat question too. Yeah, there's one here.
Yeah, Monday.
Is the bank still doing lending for self-managed super fund? Which bank, and what's the variable rates for those? So can you answer that one, Louisa?
Yeah, so we've got limited numbers of banks doing self-managed super fund. A lot of them have pulled out. I think we've got 6 or 7 still in that space. The rates, I've not got them in front of me, but the rates are in the 5s and 6s for self-managed super fund. If you've got an existing self-managed super fund, you need to go back and look at all the fees involved to change, because it's really expensive to move a self-managed super fund. But yeah, they're still available. There's just not a lot around.
Great. And another question, how long do you need to be in a new full-time job before the bank will accept your income statements?
That's changed with COVID, because we did have lenders that were taking 1 and 2 pay slips. At the minute, they're really liking to see you there for 3 months.
3 months.
Doesn't matter if you're on probation, but yeah, we might be able to get it under if you've gone from the same occupation, you've not changed jobs, we might be able to get 1 or 2 under that, but generally 3 months.
Great. And do you advise on self-managed property mortgages? So you can do that, Louisa? Mm-hmm.
Oh yeah, we do self-managed. We can't do the advice. For the advice piece, they need to go to see a financial planner or an accountant that's got a license to do the advice around the self-managed super fund to make sure it's right for them. Mm-hmm. Once they've done that and the advice is, you're all good to go, then yeah, we do the self-managed super fund mortgages. Right.
Someone is also asking, bonuses are a large percentage of my income. What percentage of bonuses do banks typically accept?
All right, so before COVID, most banks were taking 80%. We did have a couple doing 100, but that has dropped down. A lot of banks are taking 50, 60% now, but we have still got some that will do the 80, and I think we've got one that will do the 100%, but a lot of banks have changed on that right now.
Okay. And someone's asking, do you advise buying under a trust when buying more than one investment property? Well, I think that's more of a tax question, but what's your advice to that or response to that, Louisa?
Yeah, well, I can't advise on that as a mortgage broker. When investors come to us, the first thing I tell them to do is go and speak to their accountant and get their advice on the structure. So do they put it in a trust? Do they put it in joint name, sole name? What percentage split do they do? That's accountant's advice.
Exactly. I think it's up to everyone's individual situation. Look, trusts can be a really great way to own property, but they can also have some pretty serious tax implications if you get it wrong. So you must go and see an independent advisor for that kind of question.
Yeah.
Another question here. Being on JobKeeper's put my business in a great financial position. I'm a participant on JobKeeper. Am I better off coming off JobKeeper if I'm wanting to apply for a loan?
If you're self-employed and you're on JobKeeper, you won't be able to get a mortgage right now.
Okay, so there you go. Another question, what are your thoughts on reduced LMIs? Is it worth, or would you recommend saving up the difference of 10 to 15%?
Oh, look, I've never been a fan of lenders' mortgage insurance. We didn't have it in the UK. I was quite surprised that the banks do pass that fee onto the clients here. You're always best to save up as much as you can to save the LMI. A lot of investors, and Rich will know this, a lot of investors don't mind paying the LMI because they'd sooner get in the market and start getting that capital growth on the property. But you're best to speak to your accountant about that as well.
So my view on LMI is that, just from my own personal experience, is that when I was building my portfolio earlier on, I was happy to pay it because I was very much in the accumulation phase. So paying the extra 1% or 2% fee to borrow that extra, get up to a 95 or even 90% loan, because for me to save up an extra 10% was going to take me another year or more. So I was better off to actually buy the property, enjoy the capital growth and get into the market. And for me, it was just an expense. So it just as a different business case that you've got to apply for your own situation. Another question.
Tax deductible, so.
Exactly, tax deductible. Another question from Gina. Is it harder to get a bank loan through a trust? Is there many lenders that you've got that'll you can get a trust?
Yeah, we haven't got as many lenders as a normal mortgage, and the banks treat it differently. So some banks do trust lending through the retail side and some do it through commercial side, but we do it. Yeah, we don't do a lot of, most people don't do the trust.
Okay. And Peter is asking, how does changing an investment property to owner-occupier impact more than rates?
How does an owner-occupier?
I'm not sure. How does changing an investment property? So if you've got an investment property and then you become an owner-occupier, I think he's asking I think the interest rate. Well, the interest rate will be cheaper, obviously. If it's
the impact more than rates. The interest rates are cheaper on owner-occupied than investment rates. Yeah.
I think it's better off to get in touch with you for that question. So.
Yeah, I don't quite understand that one.
Okay. I think we might have to, we've just gone over the hour, Louisa. I think we might wrap it up there, but can I just say a big thank you to you for coming on the webinar with me today to share your incredible vast knowledge and your really practical tips. Really much appreciated. And I hope all the viewers there today have really enjoyed participating. Now, if you'd like to get a copy of our presentation, please just email me info@propertybuyer.com.au and we'll have both Louisa and my presentation to you there. And if you'd like to get in touch with either of us to inquire about our services, we'd certainly be very grateful to hear from you, and certainly gratefully appreciate all the referrals you can potentially send us to help grow our businesses during this COVID time. So once again, thank you, Louisa.
Thank you, Rich. Thanks for inviting me.
Thanks for being on the show. Thanks for coming. Thank you, guys. Bye for now.
Bye.